Today, we're diving into a financial tool that most people have never even heard of. But for a few, it presents this profound choice. A choice between leaving a legacy for the future and the chance to live as fully as possible right now. We're talking about Viatical Settlements.
Okay, just put yourself in this situation for a second. On top of all the emotional and physical turmoil, this whole other wave of pressure starts to crash down. Medical bills, family needs, just the cost of living. It's an overwhelming place to be, where you're forced to make these incredibly tough decisions.
And that's really the million-dollar question, isn't it? Your life insurance policy, it's designed to take care of your loved ones after you're gone. But what if you could unlock that value to give yourself some dignity and peace of mind during your final months?
So what exactly is this thing? Well, a viatical settlement is a transaction, plain and simple. You, as the policyholder, you sell your life insurance policy to an investor or a company. In return, they give you a lump sum of cash right now. They then take over your premium payments, and when you pass away, they're the ones who collect the full death benefit.
And I think this is such a fascinating detail. The word itself, viatical, comes from a Latin word, viaticum, which means provisions for a journey. It kind of reframes the whole thing, right? It's not just a financial deal. It's seen as support for life's final journey, giving you the resources you need to travel that path with a little more comfort and control.
So how does this actually work? You might be thinking it sounds incredibly complicated, but there's a pretty clear, structured path to get from the application all the way to the payout. Let's walk through it. The process itself is surprisingly straightforward. First, you apply. The provider then reviews all your medical records and your policy details. From there, they figure out what it's worth to come up with an offer. Now, that offer is based on the policy's death benefit, the cost of future premiums, and, this is the critical part, your life expectancy. If you accept their offer, you close the deal, and you get your lump sum.
Now, it's really important to know, this isn't an option for everyone. The main thing is a terminal diagnosis, usually with a life expectancy of 2 years or less. You've also got to own a life insurance policy with a pretty significant value, and you have to live in a state that actually regulates these kinds of transactions to protect you.
Okay, and this is where it gets really tough. Making this kind of decision is all about weighing the trade-offs. It's a deeply, deeply personal choice, and there are huge financial and emotional implications on both sides of the coin. So on the one hand, you get immediate cash, often tax-free, and you can use it for absolutely anything you want. But, and this is a big but, on the other hand, your beneficiaries won't get the full death benefit. Plus, that cash infusion could mess with your eligibility for things like Medicaid. It really is a fundamental choice between your needs in the present versus an inheritance in the future.
You know, theory and bullet points are one thing, but let's see what this actually looks like for a real person. Let me tell you about Maria, a 52-year-old single mom who had to face this exact decision.
So Maria's prognosis was less than a year, and beyond just the emotional weight of that, her biggest fear was the mountain of medical bills and making sure her teenage daughter, Sophia, could still go to college.
This was the money she had always planned to leave for Sophia. It was meant to be a safety net for her daughter's future, but right then, it was completely locked away while Maria's own financial needs were becoming more and more urgent.
After talking it over with a financial advisor, Maria sold her policy. She received a check for $180,000. And with that money, she was able to cover her treatments and, this was so important to her, she set up a trust to pay for Sophia's education. She secured her daughter's future now.
And Maria's own words, I mean, they just get right to the heart of it. That money let her take a dream trip with her daughter. It gave her peace of mind. It completely transformed her final months from a time of financial stress into a time for connection and making memories. Maria's story is just so powerful, but it's important to kind of zoom out and see the bigger picture here. The whole viatical settlement industry has a really complex history, and believe me, it is not the only option out there for people in this situation. You know, this industry was actually born out of the AIDS crisis in the 1980s. It was a desperate lifeline for so many young men who were often left financially ruined. But back in those early unregulated days, well, there were cases of serious exploitation. That dark chapter is what pushed states to create the consumer protections and licensing that define the structured, though still debated, industry that we have today.
Look, a viatical settlement is a huge decision, but it is not the only path. A lot of modern insurance policies have something called an accelerated death benefit rider, which lets you access a chunk of the money directly from your insurer if you become terminally ill. Beyond that, you can take out loans against your policy, you can look into charitable aid, or even turn to crowdfunding. It is absolutely vital to explore every single avenue.
And that brings us right back to the final, fundamental question. There's no right or wrong answer here. It's a deeply personal calculation, weighing your immediate quality of life against the legacy you want to leave behind. It forces all of us to ask, what do we really value when time is short? And that's a question worth thinking about.